Rohit Srivastava joins us, founder of IndiaCharts.com and a market strategist. Rohit, thank you so much for your time. First up, interesting sort of movements that we are seeing in the markets, and now we have SBI after its fantastic rally post Q3 results, pretty much pipping TCS to become India's fourth most valuable company. What do you make of this sort of change in dynamics at a time when the entire world is gravitating towards artificial intelligence, but India's IT sector is facing headwinds on the same account?
So software stocks, if you look at the Dow Jones or the Nasdaq software index, it's actually been falling for several weeks, somewhere since the 25th of December. So it's not that it just happened right now. It's just that the Indian IT sectors, started taking a beating more recently. And that is why we are beginning to observe this breakdown. I don't think it's over. It's still continuing as far as global markets are concerned, this move away, and it's being caused because of IT, because of the new technologies and the risk that people are assessing in terms of what it will mean, for business, how many employees you're going to hire. There's going to be a rub-off effect on various parts. It may not be today, but the markets try to discount things ahead of their time. At the same time, there's also a shift happening where people are beginning to buy industrial stocks. And that is why when you actually look at some of the core sector indices, even in the US, whether it's the Dow Industrials, oil and gas, transports, these sectors actually moved up while the selling has continued in the tech sector. Now, the interesting thing to watch will be whether something similar happens here, and SBI is probably one of the cases where you've actually had decent earnings numbers which have matched expectations, unlike some of the other PSU banks, which is why it's standing out in that space. And you may see this rotational performance because, as money gets out of IT, it's got to go somewhere. And that is the bet that people will try to take, where's the growth, and, money gets allocated to where the growth is, or else you search for value.
All right. Of course, value search continues to be pretty much, the boon and the bane when it comes to investors, especially retail investors. But overall, if we were to look at the big five again, Reliance Industries, HDFC Bank, Bharti Airtel, as well as now TCS and SBI, how do you view pretty much, the big five when it comes to India's stock market, the five most valuable companies? What kind of asset allocation should investors look at doing, or should some of these be avoided right now, especially the likes of TCS?
So TCS and the tech space for sure, we do have a negative view on TCS that we've published yesterday, and we are looking at further downside, and generally in the IT sector as well. So that's definitely an avoid. HDFC Bank would have been an interesting play. It has, given, short-term moves over the last year as banking stocks came back into the limelight, but it's not, the performance has not been something which is, outstanding. Probably within the private banks, Axis Bank has done far better. So in that sense, again, HDFC Bank not standing out means that we don't want to, really allocate there yet till it shows that kind of strength and momentum. Reliance Industries then is related to the commodity sector. The commodity sector has, been sort of flattish. Oil prices also have, really not taken off due to a lot of excessive production that's happening globally. So that will keep, growth momentum somewhere on the slower lane. So, out of all these stocks, I think the one that is probably standing out has been Bharti and SBI. I think those are the two that stand out of the names that you really mentioned.
Right.
And that's probably where the allocation also has ended up happening.
All right. So it is likely to be Bharti and HDFC Bank where the allocation has mostly gravitated, as well as SBI, of course, which you just mentioned, Rohit. But moving to another trend, Rohit, which is closely linked to the data that we are seeing, is around equity mutual funds. And the inflows have declined as much as 40% to about 24,000 odd crore rupees from a record that we saw in July of about 42,000 crore rupees in July last year. Now, while the graph tells us that the decline has been gradual, the pattern seems fairly definitive. So, has there been some sort of a reason why you feel that equity mutual funds are now not really making the cut when it comes to investors wanting to park their money? Because, of course, returns haven't been great, but SIP data tells us that, nobody has really paused their SIPs, and SIPs, if anything, are only growing. But why is it that investors are not looking at equity mutual funds as a category?
So, well, a lot of the SIP money would go into equity mutual funds, but I think what you're referring to is the direct investors who tend to be more active managers, which means they decide based on the current pattern whether they should increase their allocation or not. And I think since the trade deal went off, as you see your data cooling off from July, that's when the trade deal went into a limbo. And that's when you have seen flows actually slow down. Returns are, of course, the main metric that they look at. So we've seen some kind of that kind of pattern even in several portfolio management schemes where if the 1 year, 2 year returns have been dismal, people have started to withdraw funds, and that's a pattern to really think about. If the markets don't pick up, meaningfully and start generating positive returns, people would start thinking of allocating away to other asset classes. Whether it's precious metals or whether it's going back to good old fixed deposits. Those become the or even people have looked at arbitrage funds so much, though the returns slow down a little bit with the STT, but
Right.
those are alternate investments that people start considering in times like this.
Right. So, in fact, that is what the data from Gold ETF also tells us, because Gold ETFs in the same period have seen, especially, not just the trend line, which is on the incline. Just look at the graph for the month of December, followed by the month of Jan. Gold ETF is something which seems to have attracted a lot of retail direct money. So, is this trend likely to continue? What I'm trying to arrive at is that we've seen that markets have not given the kind of returns that commodities have in the last 1 year. But now that all these variables are pretty much knocked out of the equation, we know that we have a trade deal in the works with the US. The framework agreement has been signed already. Where does the story go on from here? Because you're just in the second month of this calendar year. From here, do you see some sort of push back towards equities, or do you think gold is going to continue to rule the roost for the next few months?
So there is a case for equities to do relatively better than gold and silver, and that's based on the 20-year data of the Sensex to gold ratio. When we actually look at that, then we are at the bottom end of the range. We've moved up and down in this range for 2 decades since 1992. Every time we've been at this level, the shift has happened from precious metals towards equity. So that is the simplest explanation we can give. But do remember that it's a relative ratio. What the ratio really suggests is that one asset class would do better than the other. This can also happen if one asset class goes down, like we've seen ferocious buying in gold and silver. If gold prices do drop, below 4,400, that would sort of look like the performance is changing or turning down, and that can also drive, money back into equity. So you would see the relative performance improve just if precious metals stop performing, and that's probably a likely case more than anything else, because the run up that we saw in precious metals pushed some of their monthly indicators also to the highest in like 10 to 20 years. So it was pretty ferocious. And when you've seen that kind of buying, then it does take quite some time to get that performance back. So clearly, precious metals are not likely to continue their outperformance against equities during 2026.
Right. There was also data last year, if I'm not mistaken, Rohit, correct me if I'm wrong, which suggested that a lot of retail investor liquidity got sucked out because of IPOs, and that could have potentially also withdrawn the kind of inflows that we had that we could have potentially seen in the equity mutual fund category. But again, this year, given that markets continue to be a little volatile and not offering the kind of lifetime high headlines that it used to, till 2024 or so, but what we are seeing that there isn't as much traction when it comes to IPOs this time around, and Fractal's Analytics IPO being, one case in point, because the first 2 days of the IPO opening were absolutely flat, and we didn't really see as much participation coming in either from retail investors or, for that matter, even from QIBs. We only saw that the subscription reached that 2.5 times level in the final day, the third day of the IPO, and therein as well, even the employees, which their quota was subscribed to just about 61% or so of the 2,800 crore rupee IPO. So overall, how do you make the IPO season and this year 2026 when it comes to IPOs, because we have big ticket IPOs even like NSE and Flipkart on the table?
Yeah, you're right. So if markets don't really go down too much, it creates room for IPOs to come in. I mean, we've seen it last year, even though we had so many geopolitical risks. As long as the indices remained above 24,000, 25,000, we were able to bring in a large number of IPOs, and they got subscribed because investors need to put their money somewhere. And as you saw, they ended up putting it in precious metals and many of the IPOs that came to the table. So they will look for alternate areas to invest as long as markets are flattish and not going anywhere. What usually makes the IPO market is if difficult is if the markets themselves fall significantly, and then people stop applying for IPOs. So that's not the environment we are in yet. We'll have to see how that is, but definitely there are big names like the NSE IPO, which has been pending for a long time, waiting to come to the market, and they would really need a good environment to be able to sell at the prices that most people are hoping for.
But subscribing to IPOs for retail investors, beyond, of course, that just being a bet and a lucky draw on whether they will get the allocation or not, is that a strategy that retail investors should pursue in 2026, given that overall the sentiment across the broad-based stock market seems flattish?
It's something that I don't do. My first investment in the stock market in 1992 was an IPO, and that
Okay.
was the last IPO that I've ever applied for. But
Which
then
IPO was that, Rohit?
it was some wild company known as ATV Projects
Okay.
Limited.
Okay.
And after that experience, what we really realize is that IPOs, when they come in, especially in those days, they would be companies which would be equivalent to startups. So you are actually betting on somebody being able to deliver business. Now, today, because of a lot of the regulation, most of the IPOs that come to market end up being businesses that are already sort of established, and you're betting on two things. One is listing gains, and second is long-term growth. But most people end up playing the listing gains game, which is fine if you're just getting in and getting out. And the moment it stops working, you probably stop playing that game. So it's purely trading, I would say. It's not even investing. When it comes to investing, I usually prefer to let the company get listed, let its value actually be, get the true value of what the market thinks it's worth, and then actually take an investment call.
Okay, all right. So, of course, wait for listing, wait for the true value discovery before you participate. Of course, this is first-hand sort of experience sharing from Rohit, who invested in his first IPO back in 1992. But Rohit, if there is so much volatility, so much uncertainty, which is likely to loom all over 2026 as well, do you think we should then more seriously consider parking some money, let's say, in the US stock market and look at these big tech companies, the NASDAQ-listed companies, and use, let's say, the same buy on dip strategy like we're seeing Google and Microsoft are both down about 2% plus or so? A good opportunity for Indian retail investors then to look at the US tech story.
Only where you're certain that, yeah, these are companies that will not be hit by the AI cycle. We know that this $400-500 billion that they're investing is still not clearly ROI positive, because we don't know whether the returns will come on the investments that they're making. So what is really happening is what I said in the beginning, is money is actually shifting away from tech to industrials and other economy related sectors, because that is where value is. So if you are really looking at diversifying away from all the noise that is happening here, look at value stocks in sectors that are being ignored right now. We've been chasing the same things. We probably need to look outside the universe we've been chasing.
And again, sticking specifically to the US story, now how would you rate, let's say, a stock like Apple or Nvidia? Would you call it a pure play technology stock that one should stay away from, or more aligned with macroeconomics, given that, data centers are being invested in which require GPUs, more consumption leading to, and better employment numbers also in the US, leading potentially to more demand for consumer goods like iPhones?
Yeah, it's tricky because you see, US is a very highly spending driven market. If you maintain the current rate of GDP growth, then companies like Apple tend to benefit from it because people are spending, buying phones, and that goes on. Nvidia is a very, very different bet. It's not a bet on the economy. It's really a bet on the demand for chips coming from the AI space. And there's so much changing there. There's even talks of whether the price of chips come down as new competitors step into the business. They may be in denial on that, and those are risks to getting into Nvidia at this point of time. Definitely, if there's a good correction, I don't think there's been a significant correction in some of these stocks recently. Maybe in some of the non-AI stocks, but Nvidia has not seen a very big decline. If it does happen that you suddenly get a 10-20% decline for some reason, yes, it would become attractive from a long-term basis. But right now, I'd rather just wait and watch what is happening there.
All right, wait and watch, and don't put your money unless you're absolutely sure of where to invest. Thank you so much, Rohit. We will leave it at that for this morning.